So guys, what do we do now that stocks have gone up and up and up, and we're entering in what looks to be a bull run, right? When stocks are going up continuously. That's sort of the common definition of a bull run, right? Stocks, typically the bull run is defined by stocks up 20% or more, right? After a low, right? And we've had a low. We just had a low a few weeks back or a month or so ago. And now we've gotten the last 2 days, 2 or 3 days, we've had the stock market, S&P 500, finishing higher than it's ever finished before. So we're kind of like entering into a bull run. So what do we do? The regular average Joe Schmo investor like me and you, what should we be doing in this bull run, right? We know that in a bear market that as an average investor, stocks are on sale and we want to go out and buy stocks, right? But what do we do in a bull market when the stock market is way up? Now on this channel, guys, I typically tell you this. I tell you to DCA it, dollar cost average, right? Just dollar cost average into the stock market. That way you're in the market when it's low, right? Bear market, right? Panic is setting in. Everybody's trying to sell and sell off, and you're in there buying, right? You're just dollar cost averaging. And then when you're in it, when it's high, like a bull market that we have right now, where everything is going way up, you're still in the market. When you dollar cost average just means this, guys. It means you're putting a certain specific set amount into the stock market on a regular basis, right? And a regular specific set time. For example, you put $200 a month into the stock market every 2 weeks, right? If you put $200 in the stock market every 2 weeks, and you do that over the course of a year, 2 years, 3 years, 4 years, you just dollar cost average into it. You didn't play the game of, oh, it's high, let me put in more money. Oh, it's low, let me put in less money, right? Or let me put in more money when it's low and less money when it's high. You didn't do that. You just dollar cost averaged into the stock market by putting the same $200, as an example, into the stock market for the whole time, right? So, just keep this in mind, though. When you're dollar cost averaging in a bull market where everything is going up, during that time, your dollar cost average is not obviously going to get you some of those big wins, right? If a stock or an index fund or something goes up constantly and consistently for a long time or for quite a while, then the dollar cost averaging just results sort of in minimal returns back to you, not the big returns like you'd really want. But again, when you dollar cost average, when the market goes down, you're still buying the same amount of shares the whole time. So there's some give and take to it, but dollar cost average is what I'd say on this channel. And so that's what I would say that even in a bull market like we see right now, we should be doing. Here's the kicker though. I don't want you being too hyped in a bull market, and I don't want you getting too low and too down in a bear market, right? I want to be sort of like the Tim Duncan of the stock market, right? Who is Tim Duncan, right? He's a famous NBA basketball player, professional basketball player, and he's just level-headed the whole time, right? Whether he's doing good or he's not doing good, he's just pretty much even keel. And that's kind of what I like to, think of us as regular retail investors that we should be doing, right? Just be even keel no matter what's going on in the market. Bear, bull, we're still just chill, right? So the S&P, let's real quick talk a little bit about the S&P. There's some solid S&P index funds and ETFs that are out there right now that we as regular retail investors probably should be looking at, right? I'm a Vanguard person, so I like ETFs, an ETF like VOO. But if you're on, if you buy and sell and trade or whatever on Fidelity or BlackRock or, JP Morgan or E-Trade or Charles Schwab, wherever you're at, right? Wherever you're at, try to find that ETF or that index fund that covers the entire S&P, right? No matter what platform that you invest on. Index funds and ETFs that track the S&P are always a good bet, in my opinion. There's always risk and pros and cons, but I'm a big Vanguard ETF or Vanguard index fund person, right? Because I like the lower fees and other things, right? But, be cautious. I always say be cautious. There's always some down to everything. We always got to remember, guys, past performance in a fund, ETF, index, whatever it may be, stock, right? Past performance doesn't indicate what's going to happen in the future or future returns, right? Just always keep that in mind. Things are going real good right now. There's a bull market and everything is up. Now, you go buy when everything is up, and next thing you know, in 2 weeks or a month, everything goes down. Don't necessarily look at past performance to indicate what's going to happen in the future. The S&P in 2023, the S&P was a big-time winner, right? I think it was up over 25 or 26% in 2023. That includes dividends, right? But that doesn't mean it's going to be up 26% in 2024. Just keep that in mind. The S&P 500 index is a basket or a bucket full of stocks that basically track the top 500, I think it's 506 or 507 companies in America, right? And it's what they call a weighted index or a cap. It's weighted by the cap or a cap weighted index, right? So firms or companies that have larger cap are actually going to carry more weight in the S&P 500. It's based on the weight and the market capitalization of each company that's in that bucket. Right. So a cap rate is the total of outstanding shares multiplied by the actual price of that stock. And so the large companies are in that S&P 500. When I say large companies, I'm talking large cap companies. And those are your Amazons, your Apples, your Alphabet, which is Google, right? Your Microsoft, Tesla, NVIDIA. Those are the companies that carry the biggest weight in the S&P 500. And in fact, IT companies, large cap IT, which pretty much are all the ones that I mentioned, right? Large cap IT companies are the ones that carry close to 30% of the weight in the S&P. And when you look at how they did back in 2023, they tore the roof off, right? But now they're in the last few days, they're even up even higher, right? Again, we're at all-time highs right now, guys. So, how can you invest in the S&P 500 or some type of index fund that's like the S&P 500? There's tons of choices out there, guys. I'll let you Google them. Now, as I said, I'm a VOO guy because I like Vanguard. But no matter where you're at, guys, where you invest, I suggest you start looking at some of those index funds and ETFs that track the S&P 500. Now, the reason I like Vanguard, by the way, is because in the early 1970s, Jack Bogle. Now, don't get me wrong. Index funds were around before Vanguard was around. They just weren't very popular at all. But Vanguard was created as the company to primarily sell and push index funds. And it was created by a guy named Jack Bogle in the early 1970s. So they invented it. Or not invented it, but they were the first to popularize index funds. And I'm a big index fund fan, so that's why I go with Vanguard. But for you guys, just simply buy an S&P 500 fund on whatever platform that you're comfortable with and that you own other stocks and investments on, and you'll be fine, right? But hey, as a Vanguard guy, here I even got Bogle's little book of common sense investing, right? I always check it out and read it every now and then. But so over time, guys, these passive strategies like ETFs, index funds, they've really shown better returns than individual stock market investing. So here, the things I would do, guys: dollar cost average, look at the S&P 500 funds that are out there, do your research, don't get too high in a bull run, and don't get too low in a bear market. So that's kind of how I would handle this right now, guys. Stay with your 7 strategies of investing. Don't leave the 7 strategies of investing, right? The basics. These are the things that don't change no matter if you're in a bull run, bear market, whatever's going on with the market. You invest in things you understand. You create a plan of action for yourself, right? You commit to consistency, dollar cost averaging over a long stretch of time, right? And obviously you risk whatever you can afford to lose, okay? You don't get in there and start playing with, money and make it a gambling thing where you're taking money from the rent, right, to go invest in don't do that, right? Which you'd be surprised. Also, you want to make sure you diversify your investment choices that you have. The thing about S&P 500 funds is if you're on Infidelity and you've invested in an S&P 500, you don't have to go over to Vanguard and invest in a S&P 500 and then go over to BlackRock and get one of the iShares that is the S&P 500. You don't have to do all that because you don't want all that overlap, right? You already got the S&P 500 one place. You just need one S&P 500 index fund or ETF fund. Then, of course, reinvest dividends, drips, and reinvest in the dividends so they grow as well and they compound as well. And then, of course, don't panic, don't get too high, even kill, right? Stay in the middle, dollar cost average. That's what I would do right now if I'm a regular, which I am, a regular retail investor, right? So, hey, my urgent message to you on this video was that those are the things that you should be doing right now as we enter into a bull market. Get in the market, stay in the market for the long term, and you'll do just fine in a bull run. You'll do just fine in a bear market, right? And that's what I would do. I'm going to put a video right here of my top favorite 3 ETFs that I invest in. That's all I got for you guys. I appreciate you being here. The best person who's going to take care of the old you is the young you. Take good care of yourself and take care of other people. Until the next video, peace.